Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's look at the week ahead for the week starting Monday, the 11th of March. We're kicking off with an overview of exactly what the big ticket items are for the week ahead. And certainly the dominant theme is the US and the UK. Coming off the back of Friday's jobs report, we also saw the ECB rate decision. The focus remains on the US, but shifts in Europe towards the UK, the jobs market in the UK, and the GDP numbers Tuesday and Wednesday in the US. Really, it's all about that inflation data. So I want to focus on those two areas, and as I always do, a third, I'm going to focus on gold as well after hitting record highs for the week just gone. So firstly, the US. This is the big ticket item for the week. We've got inflation data coming out. And of course, inflation data shapes expectations for monetary policy. The view is here that we're going to see flatlining headline inflation at 3.1% and a decline in the core reading. That's not necessarily going to be great news, because if the US can't even get below 3%, it says a lot about their ability to get to 2%. And potentially pushes back on the idea that we're going to see a June rate cut from the Federal Reserve. The declining core inflation is welcome, but once again, 3.7%, even that's a problem. It doesn't necessarily point towards a potential rate cut in 3 months' time. That inflation theme continues into Thursday, where we've got PPI, which is essentially the prices being paid by businesses and factories. Are we going to see a decline in that? I mean, that points towards underlying inflation pressure, so it will be important. Also, retail sales for February, worth watching out for on Thursday. And wrapping up the week, we've got industrial production, the Michigan Consumer Sentiment Survey, and some pricing data coming out from the US. But ultimately, the big ticket item really is US inflation. And I wanted to show you the two charts that I generally look towards to gauge exactly where we stand and where I think things are going to go. First and foremost, we can notice that where we are at the moment in terms of inflation at 3.1 is way away from where we need to be, that 2% target. And if you're looking for that disinflationary period to come into play, well, last time around, we saw a big number dropped out, a big figure drop out. But unfortunately, we replaced it with a 0.3, which is a fairly decent sized number anyway. And we're expecting to see another 0.3 reading on the monthly figure this time around as well. Last February, it was 0.384. And so, we could see some disinflation, but arguably not necessarily going to see much. In terms of where the big disinflationary move is going to happen, well, I mean, you look at beyond where we are at the moment, you'd be saying April, August, and September are the sort of big figures in terms of the monthly readings. But the problem here is that ultimately, if you're going to get inflation back down to target, you need to be seeing an average of around about 0.2% on a monthly basis. Last time around at 0.3, the expectation is we're going to see 0.3 again. And the US is just tracking at an inflation rate that is above target. So whether they're willing to cut rates, that is up to them, really. In terms of the core readings, this can give us a little bit of optimism. But in actual fact, last time around, we saw this pretty hefty core PCE reading of 0.418 on the monthly metric. And that really messed up all of these annualized figures. Now the core PCE figure stands to remain above that 2% target. It would be at 2.3% if in 4 months' time we are on the same trajectory that we have been over the past 8 months. So whether it's your core CPI, your core PCE, or your headline CPI, all of it points towards the Federal Reserve struggling to get inflation back down target until the back end of the year. Because if we look back at this headline CPI metric, August, September, they probably need to drop out for us to possibly get down to target, in which case you're looking for the potential for Q4 for a move to target. In terms of the market to watch, the dollar has been a really interesting one over the course of the week. First and foremost, if we're looking for a sort of longer period of time, a longer wait for interest rates to be cut, that should be beneficial for the US dollar. And that has been beneficial of late. The beginning of 2024 has seen a realignment from 7 rate cuts expected this year to now just 3. but there's a possibility it might be less than that. And that should be beneficial for the US dollar. But markets aren't necessarily thinking that way. They appear at the moment to be thinking in a relatively positive manner. We've been seeing upside in terms of equity markets and weakness in terms of the US dollar. And that's exactly what's happening here at the moment. If we're looking at price action over the sort of longer term, you can see we're caught within this chop, but it certainly does look like we've potentially topped out here. And that 4-hour chart really highlights exactly that, because we've got this swing low area around here, that 102.77, 102.9, that if we break below this zone of support, then essentially this uptrend that we've seen over the course of 2024 thus far is over. It hasn't been broken yet, but I would say, we've probably pushed through all the fib levels. So let's just go, that's 61.8. So let's put the 76.4 on. So we've moved beyond all of the Fibonacci levels, which, if we're respecting fib levels, it makes me a little bit more confident that we are actually in a retracement phase. That is not the case. And we continue to move towards the downside. And so, for me, I think there's a good chance that we do continue to roll over. If we see inflation data come in high, that could be a potential boost for this market over the near term. So if we're looking at sort of this area of support between 102.77 up to 102.90, that could end up forming support over the near term if we're around that level when CPI comes out. So I think that the CPI metric, CPI readings, going to give markets a little bit of a jolt, a little bit of a warning sign. And that essentially could lead to the possibility of upside for the US dollar. So if we're around an area of support, then coming into that meeting, I think there's a strong possibility of a rebound for the US dollar. It might be a short-term phenomenon, though, because clearly the markets at the moment are feeling relatively optimistic and they're forward thinking. And if you look further into the back end of the year, we are likely to be cutting interest rates. But I think from a US perspective, that move down to 2% looks somewhat troublesome. The second topic I wanted to talk about is gold. And gold has been breaking into record highs. The reason I wanted to highlight this is, look, I generally will pick out the week ahead and talk about the different events that are coming out. But of course, there's not necessarily a specific event for gold, or there's some for oil. But I do like to talk about commodities. And I think the commodities are particularly important because they can be highly cyclical and they can be highly relevant when it comes to, say, monetary policy, treasury yields, the value of the US dollar, all of these things, they all tie up. And gold is pushing into record highs. And that really comes off the back of that weakness we're seeing in terms of the US dollar. But ultimately, when I look for the times when gold has done well, it's at times when we're seeing monetary easing, the cutting of interest rates. That's when gold does well. And so, this year I came into it thinking gold's one of my strongest plays. And we are at record highs. I expect it to go further. The daily time frame shows you this big surge that we've seen over the course of the last week and a bit. And we're up through the 2146 mark. So the key thing here is just follow this trend and look out for the potential breakdown through your prior support levels as a signal that maybe it's starting to fade. Until we see a breakdown through that prior swing low, I would expect any pullback to be a buying opportunity. We've pulled back a little bit here. If we come into a deeper level, great. That gives you a better price to be able to get in. But ultimately, the trend is your friend as long as it is a trend. And that trend relies on this creation of higher highs, higher lows. So 21.23, if we break below that level, that's when you look to essentially say, okay, I don't know what's going to happen from here on in, because we could pull into a wider retracement given just how sharp this rally's been. But if you look at the trajectory of late, we're talking about a sharp rally, a pause, a sharp rally, a pause. So we're not even seeing deep retracement. So the pullback that we've seen at the moment, maybe that's it. And maybe we push onwards and upwards. But certainly gold, much like the other non-fiat assets, cryptocurrencies, Bitcoin, of course, hitting record highs, they're doing very well. And I would expect this year to be showing me more of that as we go forward. And then, like I said, the second theme is around the UK. Essentially, we've got the jobs data coming out on Tuesday. We've got GDP and manufacturing production data coming out on Wednesday. So this is about the health of the US economy, essentially. Unemployment rate remains low. Wages remain too high. So the Bank of England is going to want to see those wages drop down. Notably, the ECB have come out saying, yes, while inflation's falling, we've got a problem with underlying inflation, and that is all about wages. So the Bank of England will need to see wages fall. And as we see here, markets aren't expecting to see that happen. That could bolster the price of the pound if we do see that. If we see further signs of elevated wage pressures, it could also put a bit of a dampener on the FTSE 100. I wanted to show you the FTSE 100 today just because of the fact that we've been doing relatively well for once. It feels like this market doesn't really go anywhere, and you can see it on the weekly time frame. This is very different from the weekly time frame and the S&P 500. They are not the same market, and yeah, UK investors will know that. So let's hope the £5,000 a year UK ISA that the budget came out with helps things along. But certainly for the time being, we're still within this key area of consolidation, with the 77.45 level essentially capping price action over the past 6 months. And we're back up towards that level. So that could point towards a potential turnaround. It could point towards a potential bullish breakout. And certainly the hourly time frame, we can see this lower highs, lower lows, reversing into the high highs, high lows. So pullback could possibly give us a retracement and then a rally into that resistance level. But until we break out, until we see confirmation that we've broken from this, there's a good chance that we do see the bears come back into play, if only for the short term. Perhaps not, remains to be seen, but I would say that there is a risk around that jobs data, that if we see an elevated wage figure coming out and that pushes the Bank of England to take on a relatively hawkish stance, then it's not necessarily great for the FTSE 100. Talking about the stance for the Bank of England, it's notable here that the outlook for the first interest rate cut from the Bank of England is way back in August. This stands it in stark contrast to the likes of the ECB and the Federal Reserve, even though I think that the UK is likely to hit its inflation target before the US. Markets clearly aren't convinced, and that has potentially got a lot to do with the wage data. So we need to see wages fall, and as it stands, it doesn't look like that's happening. So keep an eye out for this area of support for the FTSE 100, because if we come into it and we're seeing the release of that wage data, it could be a timely reminder that there's plenty for the Bank of England to do. Even if you look at the headline inflation reading and say, hey, it looks like it's falling, we could get back down to target soon enough. Wage pressures, underlying wage pressures, provide a key concern that the Bank of England will want to address before it starts embarking on a potentially inflationary period of interest rate cuts.